again.
Uh, yes, sir.
Okay, just read.
Company overview. Mrs. Vector's Food Specialities Limited is a leading manufacturer of premium biscuits and bakery products in North India. The company sells biscuits under Cremica brand and bakery products under English Oven brand. It caters to both retail consumers and institutional clients, including QSR chains like McDonald's, KFC,
Okay.
etc.
Now, this is a case study where, Bector Foods Specialties Limited, they came with an IPO. Okay. And this happened, I think, in 2020 or thereabout. So they were, a company who we all know because they are manufacturing or making a lot of products which are being, consumed by us. The English oven bread, Cremica biscuits. Okay. And they also supply to, institutional chains like McDonald's and KFC. So they were a company which was based in, in North India. So they wanted to go for an IPO. Okay. So now the IPO details, I'll just read out. So issue type. Now, why we are doing is basically this case study. The purpose is because, they wanted to issue shares to the public. Okay. And it was already an existing company, already had a presence in North India. So they wanted to, sell the shares they wanted to bring new shareholders. Okay. And they wanted to fix a price at what price they should offer their shares. So basically, whenever an IPO is done, we look at, the companies which are there, which are, comparative companies, and look at what how they are trading, and then we try to fix the price of IPO price for the company, which is going to, issue shares to the public, or we can even do intrinsic valuation. So let's understand, how they arrived at the price and what was the purpose of this issue. So issue type 100% book build, which means, it was 100% book build. Now, most of the companies nowadays, when they're issuing shares, and we'll understand because, this is a investment banking subject, and we'll understand the all the, law behind public issues. So we'll understand, the book build, which has been defined by SEBI. Okay. Now, most of the companies which are issuing shares in the market, they, prefer a book build route. You can offer shares at a price band. Instead of fixing a price, you say my share price will between, say for example, price band which is given for this IPO was between 286 to 288. Okay, so that means the prospective shareholders, they will, bid for the shares of Vector's Food. Now this is a very narrow band here, but the band can go from, say, that can be as big as 20% difference from the, it can be from 100 to 120. Okay, so that's a maximum allowed by the SEBI. And now this band was very short and narrow. So, what will happen is that the prospective investors, they will make bids. Okay. So they will make bids, and then, the Vector Food, they are going to, collect all the money, through bids. And then they will find out, at what price they are able to get all the proposed money, which they were decided. Now, issue size was 540 crores. So they wanted 540 crores rupees. So, at what price they will receive all the money. So that will be the price at which the shares will be issued to all the prospective shareholders. Okay, suppose it happens at, say, 286 now, or 288. So then whatever price is chosen by the prospective shareholders, so the price at which they will get the 100% of the amount which they are, collecting. So that will be the price which will, be determined. Now let's, Google and find out, what is book built. Okay, and let's see, what the if we just go to Google and find out, what is a book build, and then you can just read. Okay, book build issue meaning. Okay, okay. So, Shrishti, can you read?
Yes, sir. A book built issue is an IPO or other security issuance process that the price of shares is determined by collecting bids from investors within a specific price range, the price band. After the bidding period, the final price is set based on the collective demand, reflecting what investors are willing to pay. This method allows for efficient price discovery, market-driven pricing, and better distribution of shares compared to a fixed price
Okay.
offering.
Now, there are two ways through which a company can issue shares, either through a book built, process or through issuing shares at a fixed price. Okay. Now, nowadays, most of the company or almost all the companies, they choose a book built issue mechanism. Okay. So they fix a price band because the investment bankers, they arrive at a price range at which, the share would be valued of the company. Okay, say between 100 and 120, for example. So this is the price band. The valuation book is never. I mean, of course, they can't come up with a single price. Okay, so they come up with a price band. They say the price lies between somewhere, between that band. That would be the right price for the company. Okay, so generally the price band is always fixed little lower to attract the prospective shareholders, because otherwise they'll not make a bid. If the price is attractive, then only they will offer their applications. So normally it is slightly below than the price compared to the market. Okay, so that people find that this is an interesting offer, so they can apply for it. So there will be a bidding process, okay, where people are all the shareholders or all the prospective investors, they are going to apply. So just read this bidding process further.
Yes, sir. 1. Appointment of underwriter. The issuing company hires investment banks or book runners to manage the IPO process.
Okay,
2.
hold on. Now
Price
we'll go
band
one by one.
determination. The
So
issuer
just go one by one.
establishes a
Okay.
price range of floor.
Okay, Shishti,
All right.
just hold on for a while. Just read one and then I'm going to explain that. Okay.
Yes, sir.
So first is appointment of underwriter. Now,
All right.
the issue company hires an investment banker. So what does, whenever a new company is coming up or a company which is already in existing but doesn't have any shareholders or it is not listed in the stock exchange. So what they'll do, they'll hire an investment bank. Okay. And they are also called book runners. Okay. These banks are also called book runners to manage the IPO process. Okay, fine. So, issue book will be open so that people can apply, and they'll find out this IPO book built issue. And then they'll find out what is the price at which the shares will be offered to the public. Okay. Now, the first process is that the appointment of underwriters. Now, the investment bankers, they act as an underwriters also. In case if the issue fails, then the underwriter is going to take the shares of the company. In case if the IPO is not fully subscribed, the investment bankers who are acting as an underwriter, they both act as an underwriter as well as help the company to raise the money through book build process. Now, second, please read.
Price band determination. The issuer establishes a price range, a floor price, and a cap price within which investors will
Bid.
bid.
Now, there will be a price band determination. That means, the investment bank, the company will, or the issuer, with the help of investment banker, will decide, what would be the appropriate price band, which is giving a lot of, benefit on table to the prospective investors. Okay. So the price band will be decided. Now, there will be a floor price and a cap price. Okay. The upper price is called the cap price and the lower price is called the floor price. So between these two prices range, the investors will bid. Third,
Investor bidding. Institutional and retail investors place bids specifying the quantity of shares they want and the price they are willing to pay within the price
okay,
band.
so that means there will be a bidding process which will happen. So both institutional investors as well as the retail investors, they are going to make bids specifying how much quantity they want to buy and what is the price they are willing to pay within the price band. Okay, fourth,
Building the book. The underwriter collates these bids to create a book that shows the overall demand for the shares at a different price
now this
points.
is called a book. What the underwriter will do, he'll make a book, okay, where he'll get all the data with regard to how many people have applied at what prices. Okay, so this will show the overall demand of the shares at different price points. Then the fifth.
Price discovery. Based on the demand shown in the book, the company, with the help of the book runner, determines the final issue
So
price.
now because this is a price discovery mechanism, the company is trying to find what is the relevant price at which all the people are willing to buy. Okay, so the price will be found through this process of book building, and the book runners are nothing but the merchant bankers. Then the sixth.
Allocation. Shares have been allocated to investors at the final price and the issue is closed.
Okay, so then the shares are allocated. Once final price is determined, then the shares will be issued. Okay, now let's come back to the case study here. So we have some idea about what is book building. So issue size is how much? 540 crores, 0.54 crores, and fresh issue is 40.54 crores. So what does it mean? Any ideas to someone? An offer for sale is 500 crores. So there are three, things which are mentioned. Issue size is 540 crores. Fresh issue is 40 crores, and offer for sale is 500 crores. Any idea what does it mean? Okay. Now I'll explain that. Now,
So is it so that the demand
beg your pardon?
so is it so that the demand was a little too high, so the company decided to issue more than they had decided beforehand?
No, 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 not at all. It is like I'll just tell you
Okay.
that issue size was 540 crores. And the fresh issue is 40 crores. That means the company is going to get only 40 crores. The company, Vectors Food Limited, in their bank account, they'll get 40 crores. Okay. The rest of the 500 crores, which will again come to the bank of Vectors Food, but it will go directly to the promoters of the company because they are trying to offload their shares. Okay. So that means some of the, suppose this company was started some year back and there are some investors, like venture capitalists and some investors. So they, or even some promoters who had joined the company initially, they are willing now to exit the company. Okay. So they are offering their own shares to the public. Okay. Or maybe part of it, not if 100%, they are saying, okay, we'll offload 50% of our shares. And, they wanted to now get a good kind of a return by doing so. So they want to exit and encash their money. Like suppose, for example, you are an investor. Okay. You had, given a lot of money to Bector Foods when they started their operations. Okay. And that time the company was not known at all. And you were risking your money because you never knew, it was just like a startup. And you never knew what will be, how this company is going to do. But you just relied on the promoters, their experience, and whatever they have expertise in doing this business, and gave money. Now, a time comes, say after 5 or 10 years, the company is now coming with an IPO. So it's an exit route to the existing promoters or shareholders to offload their shares. And what they're doing is they're offloading 500 crores by this process. And the company has come with an issue size of 540 crores. That means the company is going to get 540 crores, but only retain 40 crores for their further operations, and 500 crores will be given to the promoters as an offer for sale. Is that clear? Is it clear to all of you? Any questions, please?
Yeah.
Now, there are a lot of companies, who come up with, like Zomato, which came up for a public issue, or a Paytm. They all came up with, I mean, through an offer for sale also, because, already a lot of people had invested in that company and they wanted to exit. So they came up with a offer. They were offloading their own shares basically by the process of an IPO. Okay. So now the price band which the company has fixed was between 286 to 288. Now, as I told you, the price band, the has to be, maximum limit is 20%. Like, if the price lower band is 100, the maximum price band can be 120. And this is allowed by SEBI. Then there is a minimum requirement also. It can't be like, 100 to say 105. For example, the price band is 100, the lower band is 100, then the minimum, should be 105. So the minimum gap should be 5%. Okay, so that is the law as per SEBI. But as you will notice, the price band of 280 is 268, 288 is not even 100 5% higher. So if you add 286, like suppose if I do a calculation here on the screen, okay, 286, I'll just show you and see, we'll find that, this is not gelling. They have actually violated the the rule of the SEBI, okay, where, the price was 286. Okay, let me just do it here. So, it was like 286. I'll make it smaller. So 286. Okay. So if I say multiplied this by 1.05, so the price band should be, like 286 to 300 to meet the criteria of SEBI. Okay. So it was not meeting the criteria of SEBI. So, then we checked up, why it happened and how the SEBI allowed this kind of a thing to happen. Okay. So then we checked that, of course, there's nothing on record that, how the company was able to offer the shares between 286 to 288. But maybe at the back end, they might have taken an approval of SEBI. Okay. So, but there is no mention. Even if you research, we'll find that there is no mention. Okay. But since it is not allowed to do, they are not allowed to do so. So the price band should have been 286 to 300. That is the minimum which the SEBI allows. But the company was able to do away because they might have got some special permission from SEBI. So we'll talk about that later. The face value of the share was 10 rupees. Now the company came up with an issue price of 286 and 288. So somewhere, maybe 286 was the price at which, 288 was the price at which finally the shares were issued. Now just check, what is the current price of Vector. So this was in 2020 when the IPO was, coming. So now the IPO has been already listed. And if you just see the Vector's food price today, so what price it is trading? Share price, okay. So how much is trading today? So in the 5 years, if you see, the Bector's food has gone up to 1390, almost touched like 400, 1400 rupees. So at 288 rupees, which was invested by the shareholders at that time, it has become 1390. So that was in 220, okay, 2020, and now it is 2005, 2025. So even if you look at kind of a return, how much they have made, so we can even check that. So if you want to do that, let's go that. So we just open the Excel sheet and see, how much return the shareholders have made, who applied the public basically. So the price was, assuming the price was, say, 288, and currently it is around 1390. Okay. So we want to know what is the how much return. So let's say the rate formula. Okay. And the NPR is what? 5 years. Okay. This was in 2020. Sorry. So let's say this was 2000. I mean, of course, we can just put the right dates, exact dates, but I'm just saying it is 5 years. Okay, fine. So this is, 5 years. So, okay. So let's say how much return the company has got. The investors have got, rather, not the company. Then present value was 288 when the investors invested. It was 288. Okay. And what is the future value now? 1390. Okay. So when we enter, so how much return they have got? 37% return per annum. Right? It's a staggering return that you invested 288 in 2020 and it has become 225 now. So a 37% kind of a return which the investors were able to get. So coming back to the case study, so it was a very successful, this thing. So, but now if you look at, for example, just look at, Paytm. This was also a Paytm share price. Okay. So Paytm is now, what is the price of Paytm, Srishti?
Sir, it's
Now just check what was the
1216
IPO share
rupees.
price. What was the IPO price? So the shareholders have
2150.
lost money, even after investing at 2,150, the price is now fallen down to 1,260, almost like, half the this thing. Okay. So they have lost almost like 50%. If you see the trend here of, this thing, maximum trend if you see. So of course, lately the Paytm has been rising, but it was the issue price was what around when the share opened, it was close to its issue price, and then it started falling and remained range bound for several years or 2 years, and then started looking up. But still, it is 50% down compared to its peak, its IPO price. So maybe the merchant bankers, they were not able to understand the price, or maybe there were some kind of regulatory issues which were attached to Paytm, because Paytm was acting like a complete bank, whereas RBI have given permission to do something else. So they were actually not using their license properly. So that's why the share prices came down. Now the face value is 10 rupees. Share 10 rupees, 10 rupees share they were issued in the range of this. Issue opens and closing date 15th of December to 17th of December. So issue was open for 4 days. So this is the minimum time the share issue has to remain open. The maximum time is 10 days, but they said that they will able to collect all the money from 15, 16, 17, 15th, 16th, 17th. So whatever 3 days. Okay. So then the listing date was, December 2024. Okay. And the exchanges where the company had listed their share was both National Stock Exchange as well as Bombay Stock Exchange. So at both the stock exchanges, they wanted to list their shares. And the promoter name was Mr. Anup Bector. Okay. Now, objects, and who were the merchant bankers? They were SBI Cap and ICICI Securities and IFL. So these are the three companies who were called book runners and lead managers, nothing but a name given to the investment bankers. Okay. Because they are managing the book of this issuer better. Okay. Now objects of the issue. So Srishti, can you read that?
Yes, sir. Objectives of the issue: financing expansion of Rajpura Biscuit facility, general corporate purposes, partial exit for private equity
Okay.
investors through
Now, this
OFS.
was the objective. First was they were, going to finance the expansion of a factory, Rajpura factory, I mean, which is in Punjab. So they were trying to expand it and make it more bigger. So they needed some money. Okay. General corporate purpose for, I mean, other purposes, and partial exit for the private equity investors through the offer for sale. So as I told you, so they had come up with a 500 crores of offer for sale. So they wanted to partially exit. Those were the private equity investors. So they wanted to exit from the company and make a good return, because they had initially given the money to the company. Now basis for offer price. Now this is a very important, because when whenever a company is issuing shares, so they have to offer, they have to give a prospectus. Okay, they have to issue a prospectus, and they have to mention what is the basis, how this price has been arrived, so that the prospective investors, they have a clear idea about the price and how it has been determined. Okay, read this, Shrishti.
Yes, sir. Basis for offer price. The final offer price of rupees 288 per share was determined through the book building process, considering both qualitative and quantitative factors. Qualitative factors: strong brand equity, Kremika and English Oven; diversified business model, Biscuit Plus Bakery; extensive pan-India distribution network; automated manufacturing facilities; professional management with deep
So
sector
now the company
expertise.
has to give both, the qualitative as well as quantitative factors, justifying the issue price. So the qualitative factors were that it is a strong brand because it was already present and the product very, very popular. diversified business models. That means they were present into not only in biscuits but also bakery. Extensive pan-India distribution network. So that was also their qualitative factor. Then they had whole of the facilities were automated, and it was managed by professional managers. Okay. Now coming to the qualitative factors. Now, qualitatively, how are the financials? Okay. Like the earning per share was 3 rupees 16 paisa in 2020. Okay. So this was the earning per share of the company. And if you, and the P ratio, according to this 3 rupees 16 paisa, works out to be 91.14. How the P? Because the company is not trading at the moment. So we can find the P ratio by looking at the IPO price, the upper band and the lower band. Okay. So, so the upper band was what, 290. Let's just go back and see what was the upper band. The upper band was how much? 286 and 288. Okay. So I'm just putting this upper band and lower band. 286 and 288. Okay. And 3 rupees 20 paisa was earning per share. Okay. So this is, assuming that this is the market price per share. Of course, the shares are not listed, and this was the EPS. So we are finding a theoretical price. Okay. So what we do is that we divide this by this to arrive at the P ratio. Okay. So it was, from the lower band, it was 89 and upper band was 90. Okay. So which means, what they have mentioned here was correct, that the price band was somewhere around 90. Okay. So 91.14. Okay. So this was the P ratio of the company based on the upper band. Okay. Now, the return on equity was 12.17%. So this was how much they were earning on the equity. And the book value per share was 26.76. And the offer price divided by the price to book ratio was 10.76. Okay. So this is offer price upon NAV would be nothing but the price to book ratio. So NAV is nothing but the book. Okay. So it was 10.16. Now, uh, now there will be a peer comparison done. Now, as we know that, in a relative valuation, we just try to see that, what other companies were trading. Okay. Like the Bacter Food, the EPS was this, the implied P ratio was 90. Return on equity was 12%. The price to the book value per share was 26, and face value the share was 10. So the company like Britannia Industries, which was already listed, Nestle was already listed, DFM Foods were already listed. So they had published their earning per share and their P ratio and the return on net worth and NAV. Now, just look at this data and see that the observation which is mentioned there. Just read the observation.
Despite its relatively lower EPS and RONW, Mrs. Bector's commanded a PE of 91.14x, suggesting strong investor interest and confidence in future growth.
Okay. Now, if you just compare the P ratio of Bector with all other competitors who are already present and much bigger players like Britannia, the P ratio was almost half or slightly higher than the half, 51. So Britannia Industries was trading at a P ratio of only 51. Neste was trading at a staggering P ratio of 85, and DFM Food was trading at 103. Now, if you look at the P ratios and don't go and look at the future growth, because the future growth is not given here. So just on the basis of P ratios, we would say that the Bacter Food was trading, was being priced. It was pricey, IPO. That means at the time, it was, being priced at 91 times then the profit it was doing. Okay. In historically. So it was very expensive compared to its peers. Okay. Now, as we can see that, because the price today has gone up tremendously. Okay. So if we have to just compare today, okay, because, first of all, why the P rate was shown 91, and why it commanded a very good response from the investors despite being very pricey. So let's just look at the listing performance before we see the current one. Okay, just read this.
Listing price rupees 500 approx. Listing gain are approximately 74% over the issue price. Investor sentiment extremely positive with the IPO oversubscribed by 198 times overall, especially strong in retail and
Okay.
NII
Now the
segments.
listing, when the price got listed, after 3 days, after the bids were received and it was got listed, so we found that it was at $500 as against the issue price of around 288. It got and listed at 500. So that means it was 74% over the issue price. So that was a listing gain. So how was the investor sentiment? The IPO got oversubscribed 198 times, despite we seeing that the P ratio is quite high. Okay, so that means the investors were thinking that the company is going to grow at a good pace. So it has a great future in terms of growth. Okay, so that's why they accepted the price, and it got listed above, even above the listing price by 74%, and it was 198 times overall oversubscribed. And from where the money came, mostly from the strong retail and the NIA segment. Now, there are three kinds of players or four kinds of players, if we can broadly classify them. One is the retail investors. The retail means anybody who's applying shares up to 2 lakh rupees for the company in IPO process. So anybody like, the Janta, their maximum limit they can apply is up to 2 lakh rupees. Okay. Then the NIA, the non-institutional investors. Okay. For example, a very big, HNIs and those who are not institutional investors, they are called NIIs, and we'll understand them. What does exactly the NII means, and we'll look at the definition which is given by SEBI and who are classified as NII. Then we are the institutional investors. For example, banks or mutual funds or other organizations. So there are 13 or 14 such kind of organizations which have been considered as institutional investors, and we'll understand them as we go along with our subject. So these are the three main investors, and then the fourth investor is called the anchor investor. Okay, the main investor who is going to contribute the big chunk of money at the time of an IPO, and he's called the anchor investor. Okay, so there are four kinds of categories, and the maximum response which came from was especially strong response came from retail and NIA segments. Okay, just read the regulatory compliance.
Price band was 286 rupees to 288 rupees. While this band complies with the upper limit rule, cap of less than equal to 120% of floor, it does not meet the minimum 5% spread rule under SEBI ICDR Regulation 29(2). The IPO was still allowed to proceed, likely with a SEBI exemption, though no explicit public documentation of such
Okay. Now,
exemption was
as we
found.
know that this was a compliance note, like the price band was fixed between 286 to 88, whereas the SEBI ICDR regulations, which we are going to study in complete detail, after some time in the fag end of the class of our lecture schedule. So we'll understand what is this SEBI ICDR regulation means and how the company is, going to comply them. And it's a very interesting, regulation. Okay. So we'll understand it completely in our later part of our lectures. So as I told you that the maximum cap can be 120% of the floor, and has to be minimum 5% spread. So that it was not meeting the criteria, but still the company was able to do it because they might have got some SEBI nod for that or an exemption. Key takeaways. Can you read that?
Aggressive valuation justified by growth potential and sector interest. Strong brand recall and distribution helped secure investor confidence. Exceptionally high subscription showed robust demand, especially in a post-COVID consumption rebound. Regulatory price band exception reflects SEBI's flexibility
So
for
we
high
know that
demand
there was a
options.
aggressive valuation. The at the time when the share was, I mean, in the process of listing. So it was, having a multiple close to about 90 plus. Okay, as compared to its peers, their multiples were far less, except Nestle, which is a known brand, which was trading at a 80 to 85 kind of a PE zone. Okay, so let's look at the current situation of the all the peer groups. Okay, and this thing. So we can just go to the screener and look at, for example, Vector Foods.